Okay, great. Well, we're definitely honored, the three of us, to be here today to speak to you guys. We try and do this once a year at least, and it's been a couple of years maybe since I've been up here with these guys, but we're very excited to talk to you about lending today. And we're going to take a little different approach. Some of the past years we've covered what the market is doing. We all know the market is super low in interest rates. It's going to stay that way for a while, so we're not going to cover that today. Primarily when we were discussing what we should cover today, we thought, what should we cover in this panel? And we all realized there's a lot of things going on today that are very different than just a few years ago. It's almost back to, we've all been in the business, each of us, I think, a little over 20 years, so there's over 60 years experience here. But we're realizing that lending has changed a lot, and there's now difficulties that we've never seen before. So we're going to cover that today, cover all the issues, and actually we're only going to touch on 3 subjects. Income and employment, credit, which is going to be covered by Eric, and then Victor's going to be covering assets. So there's different issues that we can hopefully explain to you guys to help you avoid problems in the future. So I'm going to start off in covering the income and employment issues that are in today's real estate lending arena. First of all, we're kind of back to a full qualifying lending situation. Lenders are actually underwriting files now to see if they're going to be approvable, and we're looking at a lot of things when we're doing that. When we look at income on a borrower, we're always looking at a 2-year income stream to see that they have steady income. Anytime that you're going to lend hundreds of thousands of dollars to people with the other side having very little money into the game, we want to make sure that the income is going to be steady. So if you just have 6 months of income or a year of income, we can't tell from that if that's going to be something that's going to move forward and always be averaging the same. So lenders are definitely looking at 2 years of solid income. We're going to ask for 2 years of federal tax returns even if you're just a W-2 employee, and that's a big change from many years ago. I remember in 1990 through 2000 and some, you used to be able to, if you were a W-2 employee, just give your W-2s, we would use that income to qualify you, we'd be done with it. Paycheck stubs, W-2s. Now we also have to have your tax returns, even if you're just working a W-2 job. The reason is, there's often income that we now have to deduct off of those tax returns that takes away from your qualifying normal job income. For example, if you have an hourly wage or a salary, we're going to count all that income. But let's say you have commission or bonuses on top of that. That's a variable type income. You're not going to necessarily make the same commission every month or same commission every week. So lender's going to take a 24-month average on that. So you could have had a great year 2 years ago. The last 2 years haven't been too solid. We're going to go off the last 2 years and average that income and take that variable income into consideration using an average. Declining income is now becoming a problem. So if you had, let's say in 2010, you made $80,000, and all of a sudden in 2011, your income dropped. Maybe it was only $65,000. Usually, if it were the other way around, we would average those 2 years. Now, in this conservative environment, you'll often find that underwriters will just use that most recent year, the year that is lower. So now your qualifying income has dropped $15,000 in that scenario. So keep that in mind. Declining income signals to the lender, hey, this guy's not maybe making the same as he was before. Maybe his industry is not making what it was before. So that's how the underwriters are now looking at it. Expenses that get taken away from income, like I was saying, we get your tax returns now, and what we're looking for there is usually a couple of things. One, some people will have a side business. They're a W-2 employee, let's say, making $100,000 a year. But on the side, they have a small business that they're just starting up. First couple of years, they're losing money on that business. We go to their tax return. Schedule C income will transfer to line 12 of their tax return. And if they have a loss, now that's going to deduct off of their salaried income. You might have someone who made $100,000. They have a loss on their business. They're just their small side business at $50,000. Now we cut our income in half. So keep in mind, we look at all that. Another thing that I'm seeing a big trend these days And typically in the past, you were only able to write off 2106, or what they call unreimbursed business expenses. If you're in like a sales type capacity as a, you're a commission salesman or something like that, you have mileage you can write off, different things you can put on a Schedule A, written off as a business expense, and you think, great, I just lowered my taxable income, which we all, none of us like to pay Uncle Sam more than our fair share. But in doing that, you will often just take away now from your qualifying income. I don't know how many times I now see a borrower who's not a salesperson. Sometimes teachers will have these expenses as well, but just a typical guy working at a Big Five or something like that on a salary, and they have 2106 expenses. Maybe it's $12,000 in expense, and they've done that the last 2 years. Well, you know what? You just now took $1,000 a month away from qualifying income, because that 12,000 divided by 12 months, it's $1,000 a month that you just took away from maybe a 3,000 salaried income. Buyer might not qualify anymore. So these are things that I think if we talk to our buyers well in advance, or if you're working for buyers for a long period of time, you can let them know, hey, when you go file your taxes, we know you want to save money, but don't be over aggressive on your deductions. Sometimes it'll just really hurt you on the buying side. Partnership returns and corporate returns, we're going to look there as well if you have a corporation. And one of the things, we don't use that income as much towards qualifying. We still primarily go off the personal tax return, what transfers to their 1040s. But if you have a note or loan due and payable within 12 months that's showing on your corporation, that's going to be deducted from the income as well. So now all of a sudden you could have had someone who's well qualified, they have this that's going to be written off, they don't have a qualified buyer anymore. So we are looking at things that we didn't look at in the past, and hopefully someday that'll loosen up a bit, but we don't want it too loose, because then we'll go back to the problems we had just a few years ago. So underwriters are definitely looking closely now at tax returns and income. Self-employed borrowers. We all have self-employed borrowers, and the easy fix in the past was the stated income loan. And it was meant for the self-employed borrower, and I wish it would have always stayed for the self-employed borrower. We might still have it today. But self-employed borrowers will write off as much expense as they can, of course, to minimize their tax consequence, but at the same time, we now go off the adjusted qualifying income, whatever deductions came out. Now we have a net income we have to use. You could have a client, self-employed, making three-quarters of $1 million in a year, but they wrote off 600,000 of it. So you really have to be careful with self-employed borrowers, and how much you write off will affect how much you qualify for. Again, we talked already about the startup business. That normally will be a negative income and take away from your normal qualifying income. We're always going to ask for those 2 years tax returns. So I've had situations where you have a borrower, they never filed these 2106 expenses before, and all of a sudden their accountant says, hey, let's save you some money this year. They just file it on 2011. Didn't have it on 2010, 2009. At that point, it's too late. If I talk to the borrower at that point and say, hey, I wish you hadn't done that, amend your returns, it's not going to help. Lenders now look at that, an amended return with that circumstance. They don't like to see that. They look at it as though the buyer was just doing that to qualify, which kind of they were. We told them, hey, you shouldn't have had that expense. Now we're dealing with a lower income and they don't qualify. But there's no way to go back. You can't tell them, hey, amend that return. We can maybe use it this year. You can maybe do that. We can maybe use it next year if they then have 2 years without that expense. But again, this is just to tell you, we look very closely now at income, employment, and very differently than a couple of years ago. So you just want to have your buyers get in touch with the lenders early as possible. That way we can maybe counsel them in the right way. If damage is done already, they've already filed a certain way, there's nothing we can do, but at least we can get them prepared for maybe next year, maybe the following year, it just depends. We have to get them ready. But with that, I will try and stop with that negative news and turn it over to someone else who will give you some more information on our next subject. Eric?
Okay, can everybody hear me?
Yes.
Okay, thank you, Chris. And thank you, everyone, for having us up here today to speak to you. The area that I'm covering today is going to be credit. And what I've done is kind of broken down just a few of the things that maybe some of the most common questions that I as a loan officer get related to credit. And again, as a reminder, the information that we're all sharing with you guys here today is meant to be general in nature. So it's not me talking about what PNC does, and the same with the other gentleman here. Really, it's actual guidelines may vary. So we're going to talk about a few things, but actual guidelines and restrictions and things like that may vary by lender based on specific company policies and credit overlays. So just please keep that in mind. Again, my topic is credit, and the first section that I want to talk about, of course, are credit reports themselves. So first and foremost, all lenders require their own credit report with their own scores. The borrower-provided credit reports, the free annual reports that they sometimes have, are good really as a reference point only. And that would be the same for other lenders' credit reports. We can't use them. Credit scores can vary up or down between lenders, even if they're pulled within just a short period of time. And also, typically credit reports are good for 90 days before lenders will have to re-pull them. So if you've got a filing process, they're really good, usually good for about 90 days. The next section is letters or our letters of explanations. And these are LOEs related to credit itself. It is a good idea in practice to provide letters of explanation related to credit issues up front to help guide the underwriters so they have a clear understanding of what the situation is. You don't want underwriters drawing the wrong conclusions or guessing about anything. Borrowers should always explain the reasons for any derogatory items they have on credit, any discrepancies they may have, anything that's in dispute, and also anything that may be co-signed. So if they have any co-signed obligations on credit and need to excuse that payment or take the payment out of DTI or debt ratio calculation for qualifying purposes, you want to get that explained up front so the underwriters know how to approach the file. The next section is, or are the do's and don'ts, I guess, about credit before and during the loan process itself. So first, don't apply for new credit of any kind. So please keep in mind that every time you have your credit pulled by any creditor or lender, these scores may drop. In addition, obtaining new credit during the loan process may throw off the debt ratio calculations and affect qualifying at the end. So you want to avoid doing that during the process. Don't pay off old collection accounts and charge-offs on credit. It might seem like a good idea because you're paying off these negative accounts, but if you're paying off something old, you're changing the date of last activity on that item, and you're bringing it more recent, which sometimes has a negative effect on credit scores. Don't close credit cards, even if the balances are zero or they're not being used. Again, one of the areas that may be affected by this are the scoring factor of credit depth, of length or length of credit history. So if you close a credit card inadvertently that you've had for 15 years, you may be affecting that positive credit score somehow. Don't max out or consolidate credit cards. Some of you may have heard you want to try to keep your balances under 30% of the actual credit limits to help the scores up. And lastly, do stay current on all credit during the loan process, especially if it ends up that the lender has to re-pull credit in the end. Just having one recent 30-day late on credit may have a pretty significant impact on scores. And the last area I'd like to cover are just the seasoning requirements for having bankruptcies, foreclosures, and short sales in the past. I'm going to touch through this pretty quickly, although it looks like it takes up a whole page here. On bankruptcies, Fannie Mae and Freddie Mac on conventional loans, for Chapter 7, they require normally 4 years since the discharge date. Fannie Mae requires 2 years since the discharge date on Chapter 13, and Freddie Mac requires 4 years. For FHA, on Chapter 7 bankruptcies, typically 2 years since discharge date is required, and on Chapter 13, they need to document at least 1 year of the payout period of the Chapter 13 has elapsed with good payment history, and then of course also get or obtain written permission from the court. On bankruptcies and on these discharge periods that I'm giving you, some lenders may consider shorter elapsed time periods with extenuating circumstances, and provided that there are no late payments after the bankruptcy, so keep that in mind. Foreclosures, Fannie Mae and Freddie Mac require 7 years since the foreclosure. FHA requires 3. And like bankruptcies, on foreclosures, again, some lenders, and check with your lenders, may accept shorter time periods since then with extenuating circumstances and good payment history. And then the last are short sales, which have become more prevalent in recent years. Fannie Mae requires 2 years since a short sale date, with greater elapsed time periods if you're above 80% loan to value. Freddie Mac requires 4 years. FHA is a little different. FHA requires a minimum of 3 years from a short sale occurrence if the short sale was in default at the time of the short sale. Or if the loan was in default at the time of the short sale. Otherwise, there really is no specific time period if the mortgage and other installment debts were paid on time preceding, the 12 months preceding the actual short sale date itself. As with bankruptcy and foreclosures on short sales, lenders may consider shorter time periods with extenuating circumstances and no recurrences of delinquent payments after the fact. So if you guys want a copy of what I've put up on the screen, let me know after the meeting. We'll print some copies for you, or give me your business card and I can email it to you as well. Okay, thank you.
My name is Victor. I'm a Citibank. I'm going to touch on base on a subject that one of the key components for any transaction. You cannot do this, you cannot have this without this to finish transaction. And one of the key components too, actually. This right here, once you get through the credit, once you get through the income, and this is probably the last one people think of it, and a lot of times people are actually overlooking this. It's an asset, okay? Asset, as we know, that you can use that for down payment, use that for closing cost, using that for your reserves, okay? When lender looking at the asset, they are more looking to an investable asset. What do you mean by investable asset? Usually, in general, as we know, like saving account, checking account, your money market account, and hopefully sometimes we can use a stock market, strict stock account, retirement accounts. Okay, those are in a way lenders looking for that can use us for purpose of down payment, closing costs, and reserves. Okay. Now, more and often now, you hear that when you get to the very last of it, and people say, well, I need to see the money is seasoned. What does that mean by seasoned? Most of the lenders are looking for at least 2 months of bank statement to see money is there to determine or to qualify as a seasoned asset. By all means, that doesn't mean that if any money just coming in recently, that's not acceptable, but they need to know where it's coming from and the source of the asset or the funds. Those funds not generally usable for the purpose of qualifying. There are several reasons for that, okay? But in general, banks are looking for that. Now, providing a bank statement, be aware of, as we know that the market right now is more conservative, and the lenders are looking for closely on every piece of paper, every piece of documentation. So by looking at that, they usually not just looking for a recent large deposit, and more likely sometimes looking at the recent large pay or the debit you pay out. The reason for that because they're looking for if any undisclosed properties that you bought or any undisclosed debt you are actually paying. Okay, so be aware of that. It's a good idea that you actually talk to any vendor you're working with or someone you can trust with to do a thorough pre-qualifying, okay, pre-qualifications, and have them review that asset documentation to make sure there is no any surprises in the end, okay? So what do you mean by large deposit? There is no fine print or guidelines for large deposit, but in a way, what lenders are looking for are any kind of deposits such as cash, such as usual deposit besides your income, or any kind of undocumented asset. Okay, that's what we're looking for. It could be $100, could be $1,000, it could be $2,000. It all depends. These are underwriter discretion. So be aware that any kind of undocumented asset you deposit recently, he might account for as part of an asset he can use for qualifying for the transaction. Now, another thing that I think that a lot of times that you hear that because some of the money is coming from somewhere else and use the way to prove that acceptable to the lender is used to as a gift. Now, gift, usually lenders are looking for a few things. They are looking for donor's ability, and they're looking for the paper trails for the transaction coming from donors to the borrowers, and also that they are actually require some kind of a gift letter in some kind of form. Could be a lender's form, could be just a free form that actually the donor wrote up for the borrower. All right. One other thing just to be aware of, I think most lenders are not accepting gift when you have a investment property, purchase investment property. So be aware of that. So sometimes we know that a lot of clients we have right now, they are actually buying properties and the money is not under their account currently, and they were planning to have the money all consolidated from different area or overseas at the time of offer being accepted or just right before the closing. Okay, so be aware of that, plan that ahead of time, and sometimes some of this problem can be avoided, and you don't have to worry about very last minute, okay? And after you went through all the income qualifying, the credit qualifying, maybe the appraisal problem issue, taking care of it, and the very last thing you need to take care of is assets. So be aware that, take care of that, or prepare that ahead of time, okay? Now, also the other thing we were talking about, we'll touch base on is the retirement account. The retirement accounts are those accounts that actually that you can use. Right? It could be a loan on it, could be early withdrawal, but as long as you can liquidate it, and you can use them, okay? Some are like IRA account, 401k, pension, annuity, okay? Now, lenders are actually not going to use the full value, the current value. They usually discount it to like 60 or 70%, depends on the account, okay? The lenders might ask for additional documentation to show that those accounts are actually accessible right now, or maybe ask for a term for if you're going to borrow against or you withdraw, what will be the term. So be aware that there will be some additional document besides the statement you can provide, okay? So those are normal and are usual, so be aware of that. Now, what about people borrow money and use the money to actually for the transaction? Well, there are two sections on this one. There's a secure one and unsecure one. Secure one usually that we can use are involving that if you are using real estate or against your city or against your retirement or insurance policy. Usually those are acceptable, but you do need to check with the lender to see particular guidelines they have. So be aware of that. But those unsecured one, which are like personal loan or some kind of a loan you got or something else that is unsecured, usually those are not acceptable. Okay, so be aware of that. And cash on hand, in most of the cases, those are hard to prove where the money coming from, and those are usually lenders not going to be easily convinced and accept those income, those assets. Okay, so be aware of that. Now, there's another thing that we see not that often, but we come across a few of them. I thought it was a good idea to share that, is that you see some of them have a sweat equity. Anyone now aware of sweat equity is that if someone working on property or constructions, they're actually putting the effort, all that stuff, and they want to count that as a part of equity. If they want to buy that property, that happened to some of these situation I have that actually a general contractor working on some property that happened to be a property that somehow they're interested in buying, the seller willing to buy it and sell it, and they want to use that part of sweat equity to be part of their asset or down payment. Most of the lenders are not accepting that. Okay, so be aware of that. Okay. The asset needed or requirement to close, most of people would think, oh, we got enough money, no problem. Okay, what's enough money? The lender are looking for not just the down payment, they're actually looking for down payment, your closing costs and your reserves in some cases. And down payment, of course, wherever you grow on it, that'll be your down payment part. Okay. The closing cost contains of including lender's fee, escrow fee, title fee, and all others third-party servicing fees. Okay, so be aware that if you're not so sure how much it will be, it's better check with the escrow title and the lender how much they charge, and so that way you can have that money planned ahead of time. Now, reserve can be very different from lender and the property type. Okay, and usually a lot of times they have some kind of reserve requirement. So be aware of that. Check with lenders before you actually verify the asset or talk to your clients regarding the asset requirement. And all this right here, you can actually plan ahead of time, just right before you take clients out. Just make sure they know that the property looking for, the property they're offering for, and the down payment they are planning to put down, they should have, and they have to have additional money to cover the rest of it. Okay, not necessarily everything's cost that they need to put out their pocket in the escrow, but there are some requirements for the asset. Okay, so that's all I have for today. Thank you.
Okay, well, I guess now